One of the biggest mistakes people make is a behavioral mistake. It has to do with recency bias. And what we do is we assume that what has happened recently or over the recent past is going to continue to be the case going forward. And this brings us to this debate about investing in growth or value. And I'm going to show you why you don't have to choose one or the other. You can actually combine both of these and have a really good outcome. If you pick wrong, it could totally blow up your retirement strategy. So if you're ready, let's dive into this backtest analysis and see what would have happened over the last several years. The reason I want to bring this to your attention is because people ask me this type of question all the time. They say, look, this is what's been doing well. Why don't I just put all my money into this fund? It seems to be performing well. And so in this chart, if I were to ask you, which one would you rather have, the blue line or the red line? If this was the only information that you had to make a decision on, most people would say, well, geez, from 2009 through 2023, that blue line sure looks pretty darn good. If we compare the annualized returns over this period of time, you can see again, portfolio number one, that blue line averaged almost 14% per year, whereas portfolio number two only averaged 12% per year. Investing when you're retired is different than investing during your working years because now sequence of return matters. When you're pulling money out of a portfolio, it matters. We're more concerned with reducing risk and volatility once you start taking withdrawals from the portfolio. And so in this analysis, what we're doing is we're assuming that you started with $1 million back in January of 2009. And you took $40,000 out the first year, and then you increased those portfolio withdrawals all the way up through 2020, the end of 2022. And so you can see it would be really easy to make a mistake here and say, well, geez, I'm looking at a fairly relatively long period of time from January of 2009 to December of 2022. And it looks like if I just choose the blue line, I'm going to be better off. But now I want to show you what happens if instead of starting in January of 2009, we start in January of 2000, and how getting this wrong could really mess up your retirement investment strategy. All too often, people will show me the 10-year average returns and say, well, I want the one with the higher return. It is such the wrong way, such a bad idea. This is not how you want to make investment decisions as you're heading into retirement. But if that's how you were making decisions, you'd look at portfolio one and say, well, the last 10 years has got 9.36%. And portfolio number two has only had 7.51%. I want the higher return. Most people want the higher return. Of course, if you look over the full time period, now you'll notice that portfolio two actually performed better. But more important, let me show you what happened to your money. Again, we're assuming you started with $1 million. You're taking 4% out the first year, $40,000. You're increasing it for inflation. If you get this wrong, you'll notice now that blue line, that growth portfolio, you end up running out of money by December 31st of 2017. Whereas if you had been invested on all value stocks over that period of time, you still have the million, a little bit more than the $1 million that you started with. So here's the other mistake that we could make. We could say, well, geez, over the long term, value seems to perform better than growth. So let's put all of our money in value stocks and none of our money in growth stocks. Either way, if you guess wrong, you could end up in a really bad situation. So rather than playing that game, what I would suggest you consider is using both growth and value, and let me show you how that would have turned out. Okay, so now we're still looking from 2000 through the end of 2022. The orange line represents a portfolio that's invested in both growth and value, and you can see the outcome is the value position ends up with over $1 million. The mixed portfolio, the orange line here, has 512,000. And again, that growth portfolio would have run out of money. It was all the way to zero. The key to this exercise is understanding recency bias. If you're looking at a time period from 2009 through 2022, you'd say you would want all growth stocks. If you're looking at a period from 2000 through 2022, you'd say you'd want all value stocks. Many times people treat this like it's an either or decision. And I'm here to tell you that it doesn't have to be either or. It can be both and. You can have both growth and value to balance out these risks that you face as you transition through retirement. And of course, chances are we don't want you to have an all equity position heading into retirement. We're probably going to want you to have some fixed income and some international developed and some small cap and some emerging markets. We just want you to be broadly diversified across asset classes, across the sectors, across the entire globe. And then we want you rebalancing the portfolio so that rebalancing forces you to buy low and sell high. I hope you found this valuable. Again, recency bias is something I run into every day. I hope you don't make this mistake as you're making one of the most important financial decisions of your life, which is how to invest your money as you're heading into retirement. Thanks so much.